Well, good afternoon, everybody, or good morning, wherever you are. Do let us know in the comments where you are. We use these bits of information from you guys for algorithms and to try and get more people on board, of course. Make no secret about the fact that we're growing the business, which is one of the reasons for these videos. We want to bring information to you, but we don't want to obviously make it appear as a hard sell all the time, and also make it more interesting. One of the important things about the internet as it is these days is that it needs to provide some validity, some value to people, otherwise they'll just ignore it. And there's so much nonsense on the internet which is not proven or valid. We all know that, and one of the videos I've done recently was to say specifically that I've actually dumped quite a lot of subscriptions that I was subscribing to myself through the company for data and resources and information and market data, because quite honestly a lot of it's gone so badly wrong. I started to take a look at it and realized that either some of the top browsers, you know, Microsoft, Yahoo, Google, etc., were either pumping some of these stock names or had an ulterior motive, something behind it. I just couldn't figure it out, and I don't want to start throwing wild accusations, but I don't believe in coincidences, and there was a few specifics that were causing me real concern. One of them was a company called Broadcom, which is a well-known chip company. AVGO is the ticker symbol, the trading symbol, Broadcom. Everyone probably knows that who invests. And the other one is Micron, MU. MU is the ticker symbol for that one. And I just couldn't understand why, out of all the thousands of stocks, and there are literally tens of thousands of stocks, tech stocks trading, why these two were getting so much attention, and yet there was very, very little clarity. It's not like they were getting attention because there was something rock solid. It all seemed very, very speculative. And I've had a few messages from people saying to me things like, well, you know what, now you say that, now you mention it, you're right. I've looked through my notes and history, and yeah, they do seem to be, promoting, shall we say, some of these stocks. And it might be just that they have strong beliefs in them. I'm not saying it's not. Some of them are great companies. They're both great companies, actually. But what I would say is, why the attention? Why the focus on attention? Because at these times, those particular companies, only two I mentioned, there's many more, those two particular companies were actually and continue to go south. And the other aspect of this is that you can't ever take into your portfolio news or research that they cannot predict, such as the war in Iran. Now, you can subscribe and you can get all these great stock tips and all this data, but no one would possibly have been able to predict that was going to happen, in February this year or March this year. I think it all started in February, but it certainly escalated during March and April. And everyone's plans were scuppered. The very fact then that apparently we'd won the war, or should we say the Americans had won the war 5 times in as many days, then scuppered plans, because I was buying oil on the fact that the tech stocks were going down. I was buying oil as it went up. As the Hormuz Straits released ships, the oil price went down and the tech stocks went up. So rather than just sit on trades for a few weeks and let things roll, I was literally staying up until the early hours of the morning, trying to do something which is almost impossible, predict what I think was going to happen with the stocks. Unfortunately, I got it right with a few. There's Harbour Energy and one or two others I got right. Exxon I got right. A few of the others I got right, and did okay with some of the other tech stocks too. AMD I jumped in, and AVGO again I jumped in, because it turned out to be, after the latest set of numbers, it was undervalued, not overvalued. But looking at Micron and all these other tech situations, they're against Samsung, and Samsung stepped in and bumped Micron back down the list again. SMCI is another stock I was trading quite heavily, who all of a sudden became involved in some form of either insider trading or some form of offence, some kind of illegal activity. Their share trade dumped. Palantir, what happened to them? You know, they were the web's favourite, the darling of the tech sector, the darling of the defence sector. That suddenly went south. So all these things that looked absolutely fantastic, and they were, they looked fantastic. I'm starting to realise now that it's the opposite that's happening. And this is what I wanted to talk to you about today, is some very, very basic things. A lot of people send messages, let me say a lot, a few dozen. It's not a lot, it's a few dozen people send messages to say, but how do I get going? How do I get started? You know, well, first of all, decide that you want to do it and make a commitment to saying, okay, I'm going to put X, Y, Z dollars into this, and start small, my friends. Start small. You can paper trade. Paper trading is where you just don't buy any stock. You just create a little watch list, a list of stocks that you think might do something, and you follow it. It's that simple. You know, give yourself 30 days. So if you say you want to buy, you know, XYZ stock, make a note and make a note of the price, and add it to a watch list. Now, if you go to Yahoo Finance or Google Finance, some of the free sites where you can actually build a portfolio, it says create a portfolio. If you haven't got an account, you'll need one, of course. So if you do have a Gmail account, you can open a Google Finance account. And I suggest you do. It's quite a good platform, actually. Yahoo Finance, I've been with them for about 20 years actually, and over the years they've actually been quite fruitful. Some of the data they do provide free has borne fruit, literally, and their stuff is very clear and concise. They don't seem to waffle too much, and so make a note. If you don't have a Yahoo account, and a lot of people don't now, Yahoo used to be the favourite for email, didn't it, years and years ago, but they changed their platform. And when they changed their platform, I think about 12 years ago, 15 years ago maybe, lots of people left. And they went to Gmail, which then used an almost replica of the platform that people left for Yahoo, which is a shame. Because Yahoo email I thought was very, very good at the time. But there we go, life goes on. So get yourself a free finance account, create a watch list, and you'll see the little plus sign. When you see the plus sign, you add new stock. So if you say, for example, you want to add Microsoft, you add MSFT, and you add the price. So when you've added the price and you've got MSFT, that's the very start. That's the beginning of your new watch list. All right. I don't mean a watch list. I mean a watch list. So when you start to watch your list, you can then add to it. And there's nothing wrong. You can add as many stocks as you want to that list. It doesn't matter. It's all free. And see how you get on after 30 days. Now, I'm at the moment quite pleased to give anybody that I'm working with or for, I'm quite pleased to give them somewhere around 10 to 15% a month. And we do have a program which offers a guaranteed fixed return. Now that's a risk to us as well, to my company as well, because guaranteeing a fixed percentage every month in a falling market means that we've somehow got to find the money somewhere else. So we do. We will support that position, and we will make sure that they do get whatever they signed up for. Positions start at 3%, 4%, 5%. It depends how much you've got to put in. Depends upon your risk and exposure. But you will get a guaranteed return every month. That's something. Now, I don't want to promote that service in this video. What I want to do is say how to start. So how to start. Here's a great way to do it. Walk around the supermarkets, and if there's anything you see, and a lot of supermarkets do have this situation quite often, if you see where the shelves are low on stock and they haven't been topped up, have a look. Now, one of the things that happened some time ago was a particular shampoo. I won't mention the name, but it was a particular shampoo. It's an anti-allergy shampoo, and they had a big campaign on it. I noticed it myself because my wife was showing me on her mobile phone this advert, and I thought, I know this company, I know who makes that product, and they're very, very good at what they do. Well, sure enough, they'd sold out when we went to the supermarket. We went to another supermarket, not just because of that, but because we were looking for something. They'd also had a big purge on it, but we're literally just topping up. So we said to the girl, "Oh, you're just topping up? We just arrived, just got the stock." She said, "This has been nearly empty all week." So lo and behold, I get back, I have a look. That company had done very, very well, and the share price was starting to soar. I believe at the time it was Lever, her Lever Products, who owned the company at the time, but don't quote me. I'm sure it was Lever. They own a lot of household cleaning agents and shampoos and soaps and detergents, that kind of thing. But I could be wrong, but I'm sure it was. It was an anti-allergy shampoo. Anyway. But here's the basics. Supply and demand, okay? If there's a big demand for something, and look, you can see this out on the streets. If you go to a fruit stall, and you know it's a hot day and people want, you know, oranges, and the oranges are sold out, there's a big demand. So maybe the price of oranges will go up. You know, let's look at for example the pandemic, which is a classic example. I don't really like to talk about it very much because there's so much negative news attached to it. But here's the thing that happened. The first days of the pandemic, we all saw on the TV, the news, these people walking out of the supermarket stacked up with toilet rolls, didn't we? Personally, I couldn't believe it. I thought, what are they going to do? Poo themselves to death? I mean, come on. There was literally hundreds of toilet rolls in their shopping trolley. And they weren't the only ones. And people were actually stopping those people and saying, "Hey, guys, come on, you know, leave some for other people." But no, they bought them and they wanted them. And at the end of the day, when the pandemic finished, we see news where these people are actually throwing them into the rubbish because they didn't need them, they didn't use them, they're just greedy and panicked. So there will be situations where people panic buy, of course there will. Now the other thing that happens is, you know, you get the opposite effect where something isn't selling and there's a glut and they'll cut the price and desperately try to sell it. If that's the case, you avoid that stock. You know, you don't want to be buying something where there's no demand for it. So here's the thing about war. There's a very old saying my grandfather told me, and he really did say this. He was born in 1899, passed away a few years ago, but he said, when you hear the cannons firing, buy. When you hear the trumpets blaring, sell. Meaning, when you hear the sound of warfare start, good time to buy. When you hear the sound of trumpets and celebration, sell. And it's a bit like the old adage where you want to be the black sheep in the flock of sheep. That's fine, because we don't follow sheep, and I specifically don't. I'm very, very adverse to media-driven stocks. Media-driven meaning if it's in the news and it's getting a huge amount of publicity, it may very well go up, but I'd need to know why it's in the news. I'm not saying it's a wrong thing to buy that stock, but I'm saying it's the wrong thing to buy it without knowing why you're buying it. Now, just for you starters out there, when you're looking at stocks, if you have a look, all you need to know is one or two very basic things. Have a look at the 52-week high. Okay, that stock's readily available. Sorry, that information is readily available. Have a look at the 52-week high. 52-week high is 1 year. Okay, now have a look at that and see what that is compared with the price now. So let's just say you've got a 52-week high of $210, and you're looking at a stock at the moment is sitting at $167. So you know you've got a $30-40 window there where it may very well go up. So you've got that piece of information that helps you say, well, it's not at its highest point. Okay, now have a look at the 52-week low. Okay, and you'll find yourself an average. You add the two together and divide by 2. That will give you an average. Now the other thing you can do is also have a look and see when the last accounts were published, when the last numbers were released. They say numbers, it's accounts. You know, every business has to release accounts, audited accounts, and in the American stock market it's the SEC, Securities Exchange Commission. and they will audit the accounts, and they will take the numbers and they will release them. Now, there's other things involved in a business, especially in the United States of America, the USA, which is what I strongly suggest you focus on for now, is the USA. It's the world's biggest market. It's the most liquid, which means it's the easiest to buy and sell. You probably, very unlikely, will ever get stuck selling because the liquidity is there, the cash is there, the money's there, the flow's there, the volumes are there, okay? So that's a very strong point, is to make sure you're always in a liquid market. Now, with the USA, when companies release their accounts, they do so, say for example, every quarter. So every year is broken up into 4 quarters, like a pie, okay? You've got something like January, February, March, and then April, then you've got May, June, July, and it goes on like that, okay? So every time there's a release of figures, it'll be something like the 30th of April, you know, then the 30th of July, the 30th of September, 30th of December, something like that. And those figures might come out a few weeks early, they might come out a few weeks late. If the figures are late, don't panic. A lot of companies just take time to put figures together, accounts together, but they will be fined. Now, the other thing that they've got to do is they've got an IRS, the Internal Revenue Services. They've got a liability to them. Just like you would in the UK, you've got income tax with the inland revenue. The USA has the Internal Revenue Services, the IRS. You've probably heard about it all the time. Who's watching me now? The IRS? They probably are, because they're watching everybody. In America, just as a by note, in America, if you're a businessman or a traveler or someone that does, you know, travel the world, and you've had businesses and you've worked in different locations, you are taxed from cradle to grave, effectively, okay? Every dollar you make, wherever you are in the world, they know about it, and don't ever assume that they don't. They do. They'll find you if you think they don't know, and you need to be very, very honest and open about what money goes in what banks, because no matter where you are, those banks report every dollar, and it can be in another currency, that comes into your bank account. And that's for Americans, taxed to cradle to grave. Seems unfair, it is what it is. We can't change that. For Brits, you're in a position where you can travel the world, and whatever you earn in the UK is taxed at the rate you normally get taxed at. And if you're self-proclaiming, or you know, you do your own self returns on tax, then you know, your accountant will tell you what you're going to pay. Can be anywhere from 25% up to 50 sometimes. Now, the other thing about buying stock is this: only start small. What I suggest you do is maybe put $1,000, $2,000 just for a start into an account. There's a couple of links going on to this. One is for Saxo, S-A-X-O, Saxo Bank. Personal recommendation, yes, I've used them. I used them for 15 years, and they're very, very good. And the nice thing about Saxo is you can sell your stock and buy your stock, no matter how big your account is, the same day. Now, IBKR, Interactive Brokers, is not the same. IBKR, I'm with them now, I'm using them now. I found the service to be excellent. The data is very accurate, the app is good, the website's great. I've got no issues with the tech support. Other than this, is that unless you keep a specific amount liquid or a specific amount in stock, you can only sell and then buy again after 24 hours, which when you want to move fast is very, very frustrating. I've just had some issues recently with someone. I've been trying to help them with a new account, and I said to them, you need to wait till the next day at least, because they wait for settlement if you haven't got the amount of liquidity or the amount of funding on your account, not just liquid, but the actual stock value. And I think the figure was about 25,000 US dollars at the time. So be very careful. So when you sell that night, you might have had a result. You might just be selling for profit or liquidity. You can't immediately go out and buy again until the next day, okay? Now that's Interactive Brokers. So have a look. Now there's a couple of others. There's Tiger Brokers. I think they're in Singapore. Also, I've tried them, worked very well with them. Not a bad company at all. Very straightforward to open. a good regulatory board with Singapore. No monkey business there. Great little company to start with. And just slowly build yourself up. I don't want to go on too long about starting off trading because I've got more videos to do today. But that's a great way to start. And you know what? When you've got profit, don't be greedy. What I suggest you do is set a price, set a target, a percentage maybe, that you're happy with. Now for me, I started off, it was 15%. And all of a sudden I realized I was hitting way over that. So I waited a few months until I was getting more consistency. And then we reset it at 25%. Now I'm still sitting at that now. If you can make 25% on a trade over a matter of weeks, and your banks are paying you 3% a year on 100 grand in the bank, which is probably as good as you'll get anywhere on average, then you're doing very, very well. So what I suggest you do is don't be greedy. You might see stock going up. Here's a key. If you see a stock going up, calculate how much you've put in and how much profit you've made. Sell half or a percentage of it and let the rest go. Okay, so you let the rest go, so the risk is reduced, and you know your profit is sitting there to go into another stock. So good luck, guys, with everything. I hope that's given you some help. You know, my details are in the bio. I'm happy to answer any questions you've got, and I wish you all the very best. Thanks for listening.